This is Scott Becker with the Becker Private Equity and Business Podcast. I want to thank you for listening. Today's discussion is 6 keys to investing. So we talk about this a lot because we think it's so critical to people and to their long-term financial health, and hopefully it gives them some mental health, but we know that those two things aren't always correlated. But 6 keys to investing. The first thing is, if at all possible, start early. So try and get yourself or your children started early. If you leave money in the market for the long run, you're in much better shape. You put it in an index fund. Don't try and pick individual stocks unless you live in that world. Don't try and do that, but start early. The second concept is really similar. Don't try and time the market. The long-term goal is lots of money in the market over the long term is likely to be the most successful. So don't try and time the market. Keep your money in the market for the long term and go from there. It really starts with the concept of start early, invest early and often, and don't try and time the market. The third concept is understand your allocation. There's different ways to allocate stocks versus bonds versus cash. And one of the critical things is to understand this allocation. I've got a conservative allocation, which is heavier in treasury bonds than stocks. My stocks are almost all in an index fund versus direct stocks. But understanding your allocation is so important because you need to live with that allocation through ups and downs. So if you have an allocation that's heavily weighted towards stocks, that might be great. It might be the optimal allocation for the long run, but you got to make sure you can live with it through good times and bad times. When the market crashes, that you don't freak out and sell on the dip. Many of us have a hard time not doing so. So the concept is really understanding your allocation, really spend time up front, understanding your allocation, how you're going to allocate stocks. The fourth point is know what you are investing in. So, for example, the core concept is I'm investing in 2 basic things. I'm investing in an S&P 500 index fund. I do it through Vanguard. It's got low expenses. I love it. But I sort of know I'm investing generally in the equity market. I'm not trying to make special bets on special stocks. I'm not smart enough or good enough to do so. So know what you're investing in. The other core thing that I invest in is treasury bonds, and I sort of know what those are. And over the years, I've learned about duration risk versus credit risk versus other things. Those are my 2 core holdings, and I sort of understand those things. Then there are other things I do with a smaller part of my portfolio that I don't really understand. I famously got killed on Bitcoin. I lost money in cannabis stocks. I just really never understood them other than the fun of the game. But for your core holdings, what you're really trying to invest in, know what you're investing and understand it. If you don't, you shouldn't be investing in it. It's like the guy at the poker table who doesn't know who the sucker is. You're the sucker if you don't know what you're doing. That's the perspective on it. The fifth point is, have a core holdings staples concept. And for some people, it's heavy diversification. They're going to own 30 different stocks. For me, no. It's owning the S&P index fund. That's my core, plus treasury bonds are my cores. But understand what your core investments are. Then if you want to play around and gamble on some stocks, because that's really what it is, gambling on specific things you know, with strong conviction on, that you've not done a lot of studying around, that's gambling, but fine. But first understand what your real core is and what you're really doing, as your core investment portfolio, core investment strategy. The last point that we'll make is this basic one, but it's so important, is don't borrow to invest. Financial planners might talk to you about here's how you could arbitrage borrowing money against your house, borrowing money against here, borrowing money against there to invest. And over time, you're going to make 8% of your investment, but you're going to go 5% and the 5% is deductible. No, 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 no. Don't borrow to invest. Too many stories of people jumping off buildings who borrowed to invest, bought on March, did other kinds of stupid things. Don't borrow to invest. Those are 6 points on investing today. Of course, there's so much more to this, but those are 6 keys for the day. I hope you enjoy this. Text me 773-766-5322 if you listen to this all the way through. You're the first person to listen all the way through it. You text me. We will send you a $100 Amazon gift certificate. Amazon's up almost 40% plus year to date. Thank you for listening. Thank you to Chanel Bunger, our magnificent producer. We can't tell you how much we appreciate all your help every day. Thank you very much.